Welcome to the Daily Block, the top events from the past day in crypto and why they actually matter for traders who survive on FOMO, logic, and expired margin calls. First story: SEC adopts generic listing standards. Spot crypto ETFs will be faster to list. The SEC dumped a shiny new generic listing pathway that slashes the ETF review timeline from the tortoise-like 240 days down toward a sprinter-friendly 75 days for qualifying products. That means exchanges can lean on a uniform framework to list spot crypto ETPs faster. And Bloomberg nerds already started penciling in a stampede of new token ETFs beyond just BTC and ETH. Expect paperwork to become less of a moat and more of a speed bump for issuers. Why it matters. Faster ETF approvals mean easier institutional and retail on-ramps, bigger potential inflows, and compressed free float that can turbocharge prices or make launches extremely volatile. Risk counterpoint. Faster listings also mean more crowded trades and launch squeezes that reverse fast once early demand dries up or token economics trip everyone up. Sliding into the next one. Second story. Fed cuts rates 25 basis points. First easing of 2025, markets react. The Fed shaved 25 basis points off the Fed funds target to 4.00 to 4.25% and basically winked that more easing could be coming. Crypto spiked on the dovish pivot as money market yields drop and liquidity tiptoes back into risk assets. Traders are treating this like a macro tailwind for BTC and alts, but still parsing Powell's tone for whether this is the start of a real reflation or just a one-off. Positioning in money funds and ETF demand will be the next major thing to watch. Why it matters. Easier policy usually lifts risk assets and can accelerate ETF inflows and leverage. Late-cycle alt season setups just got a friendlier macro backdrop. Risk counterpoint. A single cut doesn't erase recession risk or inflation surprises, and a hawkish pivot later this year would yank liquidity out from under-leveraged bets. Next up. Third story. Bitcoin holding 115 to 117K as ETF flows. Halving cycle and 1 through 65-day clock converge. BTC reclaimed and held near the 115K, 117K neighborhood after the Fed move, driven by ETF demand math versus daily supply. Analysts are pointing at a Y1000 65-day post-halving window that, historically, has flashed cycle top risk in the September/October range. Combine that with spot ETF inflows versus A4 and 52 BTC's day issuance, and you've got a tape that's equal parts squeeze setup and distribution theater. Miners, flow parity, and that calendar clock make the next few weeks high stakes for anyone carrying size. Why it matters. Traders must watch ETF net flows, key support at 115K and liquidity events. This is where squeezes and big swings happen as distribution picks up. Risk counterpoint. Cycle math is probabilistic, not prophetic. Strong sustained inflows could invalidate the top thesis, while a sudden outflow or liquidation cascade will make those levels look fragile. Moving on. Fourth story. First US XRP spot. AF begins trading, Rex Osprey, plus Ripple lands institutional deals. An XRP spot EFI Rex Osprey went live in the US, offering a regulated, custody-free on-ramp to XRP exposure, and Ripple quietly announced institutional plays with DBS and Franklin Templeton on tokenization experiments using the XRP ledger. That double whammy ramps institutional access while feeding a use case narrative beyond speculation. Technicals watchers flagged $3.10 or $3.20 onis as the breakout pocket for momentum squeezes. Why it matters. A tradable US ETF for XRP removes a friction point for big allocators and can produce immediate order flow, gamma squeezes, and outsized short covering moves in XRP and correlated alts. Risk counterpoint. Regulatory calm can flip quickly. ETF flows can be front-loaded, and reversal risk is high if institutional enthusiasm cools. Next story. Don't blink. Fifth story. Grayscale's Digital Large Cap Fund, GLDC, GDLC approved, multi-asset crypto ETP. The SEC gave the green light to Grayscale's multi-asset ETP that bundles BTC, ETH, XRP, SOL, ADA into one NYSE ARCA ticker, letting institutions and advisors buy a diversified crypto basket in a single trade. This is first of its kind for a regulated multi-asset product, and it follows neatly from the SEC's generic listing update. For allocators who don't want to fiddle with individual token selection, this is one-click diversification. Why it matters: a regulated multi-asset vehicle concentrates inflows into altcoins, as well as BTC ETH, so expect rapid reallocations that can lift the market caps of major non-BTC tokens quickly. Risk counterpoint: basket products can hide concentration and liquidity mismatches. Heavy flows into the ETP could create slippage for the smaller components when exits happen. Micro-transition: flip the page. Sixth story: Binance in talks with DOJ to lift independent monitor. BNB rallies past $1,000. Bloomberg says Binance is negotiating with the DOJ to reduce or remove its 2023 independent compliance monitor, and the rumor mill coincided with BNB tearing past the $1,000 mark on renewed risk appetite. Less oversight being priced in easels cleaner optics and potentially more volume for the exchange, which is catnip for CEEX-linked tokens and ecosystem alts. Market chatter about easing enforcement has a habit of moving prices before official announcements arrive. Why it matters: any material reduction in oversight cuts a major regulatory overhang, potentially boosting trading volumes, token economics, and sentiment for Binance-centric plays. Risk counterpoint: negotiations can fail or lead to different enforcement terms. The mere hope of relief can spark a pump that reverses when the fine print shows up. On to the ugly stuff. Seventh story: major security alert. North Korean-linked hacks cost 400 ms. A supply chain compromise tied to state-linked actors exploited a service provider and siphoned roughly $400 million in crypto, underscoring that third-party risk is not a bug. It's the whole system sometimes. Industry heavyweights called for immediate hardening, better vendor vetting, and stricter custody procedures, while traders quietly rotated capital into perceived safer venues. The incident has already triggered short-term risk-off flows and a re-rating of some custodial exposures. Why it matters: security shocks change liquidity, tighten spreads, and can force sudden withdrawals. They're a critical risk for intraday liquidity and leveraged positions. Risk counterpoint: fixes and tighter processes will follow, but they're slow. Meantime, crowded plays or reliance on a single custodian are betting on hope. Last main story: Dogecoin ETF launches. Doge market talk, $1 targets, and meme coin rotation. The first US Doge spot ETF hit the tape, and corporate buys like Thumbs Up fueled the meme revival, with analysts and community pundits hawking targets between 0.45 and a moonshot $1 if ETF momentum persists. Technicals show key resistance must be cleared, and with retail FOMO and leverage back in, short squeezes and gamma events are absolutely the default outcome on ripples higher. ETF inflows, funding rates, and listed options flow will be the DNA of any meme coin move now. Why it matters: meme coin ETFs plus whale buys equal explosive retail demand and fast squeezes. These trades can make and break accounts in hours. Risky counterpoint: meme pumps are often front-loaded and brutal on the unwind. Leverage and options skew amplified downside when sentiment turns. Quick bonus: pre-sale and degenerate plays traders will fight over. Remedix, NextChain, and blockchain FX pre-sales are pulling in sizable rounds, and referral staking mechanics are actively driving degen flows. These are ultra-high-risk, short-term liquidity plays that explode on PR and evaporate on lockup cliffs. Packed swap adding native Doge and Polygon swaps without bridging wrapped assets is useful for traders shifting Doge liquidity, but it also means faster flows into high-beta meme coin trades. Why it matters: pre-sales and bridge list tooling create quick liquidity rails for speculative flows that Reddit threads love to snipe. Risky counterpoint: pre-sale mechanics, lockups, and token concentration can trap buyers. Assume volatility is a one-way street until proven otherwise. How to use this list if you trade like a day-one Reddit strategist. Macro is the leash. Fed cuts plus SEC rule changes set an overall bid. If ETF flow confirms as net inflows, bias toward risk on. Track BTC pivot levels. 115K as critical support. 120K, 124K as initial resistance pockets to watch for breakouts or failed breaks. Alt catalysts are ETF launches and large listings that can spark violent squeezes. Always check open interest, funding rates, and short concentrations before diving in. And finally, risk controls. Keep stops tight around regulatory and security headlines, and size pre-sale meme allocations tiny. They move like drunk cheetahs and reverse faster than tweets get deleted. If you want daily snark with actual edge, hit subscribe and stay tuned for the next block of chaos and alpha. That's today in crypto, where the gains are imaginary and the pain is real.